Stocks will end the year higher from current levels.
This is kind of a risk-off environment at the moment.
Transportation costs up again, airline fares up.
Do you think the economy is going to run out of steam?
I don't know if people want to have that much risk.
The market's been resilient.
And this autoworkers strike probably not going to help.
You have all of these contrasting signals.
As inflation comes down, companies don't have as much pricing power.
The yield curve is still dramatically inverted.
Once a central bank feels that they've reached a point where the data is sufficient for them to sort of reach their last hike, it's going to take a lot of uncertainty out of the bond market, and that would trigger a risk rally. There's a lot of folks here who think once the Fed says they're done, they think the stock market actually continues to go down, but I think the opposite reaction is going to take place. If they keep rates here, okay, at 5.5%, and then year-over-year inflation next year drops to 2.5, that's a huge increase in restriction, probably enough to put us in a recession. So I think the Fed would be in a position to actually cut, only to keep real rates constant. I think they want to keep higher for longer real rates. They don't want to increase real rates. Since August, it's really been a game of inches. I don't know if people want to have that much risk in August and September. I do think once the market, again, reattains its sort of uptrend and risk-on mode, I do think the AI names are going to be places people come back to because there's real growth there. But
we're obviously closer to the end of this hiking cycle than to the beginning, so the market is seeing that as a positive sign. And actually, since last night even, the probability of a Fed hike has changed a little bit. But last night it was 2.8% for next week. Now it's up to 3.8%. So the market does not expect any surprises out of Jerome Powell next week. And I think we're pricing in the increased likelihood or the increased expectation that we pulled this off and that there would be a soft landing and that we can sustain higher inflation without breaking the labor market. I think some of the negatives that you look at with this CPI report and everything that came out is, number one, the measurements that we have. So we talk about core and removing food and energy from the equation, and then this super core, which also removes shelter from the equation. It starts to sound like, well, if you just take out everything that might be a problem, the number will look okay. But the reality is that consumers cannot remove all of those items from their daily lives. So it continues to take a bite out of that, and I would expect it to start showing up in spending as the months drag on. We've got gas prices at a one-year high, and you've got, even in that CPI report this week, transportation costs up again, airline fares up quite a bit, and taking a bigger bite out. And this auto workers strike probably not going to help any supply issues that we may have on the car side of things. So yes, consumers are facing an uphill battle. 9.1% last summer to 3.6% today is a big slowing, but it's still growing. Prices have not fallen. As inflation comes down, what happens is companies don't have as much pricing power. They can't pass it all through. They can't justify it as much anymore. And then you start to see margin compression. And I would expect it to accelerate into the end of the year and into next year as we see margins come down even further. There's a lot of chatter out there about this time being different, and because it's taken so long and we haven't spotted this recession that everybody's worried about, that maybe it just will never come. But if you look at the time between when this hiking cycle started, we're now in the 17th to 18th month of that. If you look at the time after the yield curve inverted at the 2s, 10s in a decided fashion and stayed inverted, we're 14 to 15 months into that. This is exactly the time when you start to see some of those issues rear their ugly heads. And I would expect it to start to show up in things like credit deterioration. There are natural effects that occur as you tighten policy and as you restrict capital in the economy. And I think the Fed is going to get what they want. They're going to restrict capital enough to bring inflation down. That never really happens without some collateral damage. We're just not sure how much and when it'll actually show up.
We have had this lift in earnings estimates. It's been slight for the S&P, but it's actually been rather robust for the NASDAQ. They're up about 9% over the last couple of months. So that's acting as a little bit of a floor under markets. And I think it's one of the reasons why markets have been able to shake off the higher interest rates, which normally would put more downward pressure on valuation.
Are they too optimistic?
Yeah. The NASDAQ 100, which itself is a concentrated index, the upside to those earnings estimates is really driven by just three names: Amazon, Meta, and NVIDIA. And even the rest of the Magnificent Seven aren't seeing higher earnings revisions. So just as the market leadership is narrow, earnings estimates are narrow. So it does put the onus for the rest of the market to participate.
Is that the one thing that would cause you to be more cautious?
I do think that it is an earnings revision down cycle, because all this year flat has been the new up. We haven't seen earnings estimates get cut. They've been raising a little bit. If we go back to a world where earnings estimates start getting cut again, that's looking a lot more like 2022. And that's that's where you'd say we would expect more than just a short and shallow kind of correction. But if the economy continues to hold up and economic surprises continue to push economic forecasts higher, that's why we're seeing earnings estimates raised.
Yeah, but which side are you leaning on, though? Do you think the economy is going to run out of steam? It surprised so many people. There's been so many things that could have gone bad, but they haven't really. The market's been resilient. It's hung in there.
You can point to things like bankruptcies within subprime auto lenders causing you to get scared and think maybe that there's issues with the consumer at the lower end brewing. But then you have the Empire Fed manufacturing survey coming out today showing a big jump in new orders and future expectations. So businesses may be saying, hey, recession averted, we can hire more, we can spend more. So you have all of these contrasting signals all over the place in this market.
The yield curve is still dramatically inverted.
Yeah.
Right. Leading economic indicators still aren't great.
We don't think that we'll have a recession in 23. So the calls for an entry into recession in the fourth quarter, we don't think are founded by the data. We don't want to rule out a recession at some point in 24, but based on the pace of the data that we're seeing today, it's looking much more like late first half into the second half is the first that we would see it.